everyone, and welcome to the Coin Cobber channel. Today, we're going to talk about something really interesting, a sort of forgotten moment back in late 2025 that, believe it or not, completely set the stage for a massive move in the crypto world. All right, so let's set the scene. Think back to late 2025. The mood in the market, it was pretty grim. Bitcoin had pulled back to around $80,000, and if you looked at the fear and greed index, it was just flashing fear day after day. You know, it really felt like we were sliding into another bear market. But, and this is the key part, under the surface, something huge was brewing on the macro level, something that was about to change everything. So to really get what happened next, we need to pull back the curtain on this powerful, almost invisible force that was just quietly squeezing the life out of the market. And it all comes down to two letters, QT, Quantitative Tightening. So what is QT? Honestly, the simplest way to think about it is like a giant money drain for the entire economy. For a while, the U.S. central bank, the Fed, had this drain wide open, just sucking cash out of the system to try and cool down inflation. And when you do that, when you tighten the money supply, it puts the squeeze on all kinds of investments, but especially on riskier assets. And you know what's on that list? Crypto. And here's how that drain actually works mechanically. So the Fed holds all these bonds, right? When one of those bonds matures, basically when they get paid back, they just don't do anything with the money. They don't put it back into the system. It just, poof, it's gone. With a few keystrokes, that cash is literally extinguished from bank reserves. The total amount of money in the system actually shrinks.
Okay, so here's the catch. The drain, well, it was working a little too well. By the time we got to late 2025, the whole financial system was starting to creak and groan. You could see these serious signs of stress. Why? Because the amount of cash available, what we call liquidity, was getting dangerously low.
And this wasn't just a hunch. You had experts basically shouting from the rooftops, warning that if the total cash reserves in the banking system dropped below this critical floor, about $2.5 trillion, things could get really ugly. A real crisis. And guess what? We were getting right up on that line. And look, the Fed had seen this movie before, and they did not like the ending. They had this really stark memory of the Repo Crisis back in September 2019. It was the exact same problem, not enough cash in the system. And what happened? The rate for banks to borrow from each other overnight just exploded. It went from like 2% to 10% in a day. That's the kind of chaos they were absolutely determined to avoid this time around. Okay, so this is where it all comes to a head. The system is on the brink, the Fed is getting nervous, and that brings us to the big turning point. They were basically forced into a surprise move, a pivot that would completely change the game for 2026. So here's what happened. First, in late October, they cut interest rates a bit. Okay, that was expected. But then on December 1st, the real bombshell dropped. Suddenly, and way earlier than anyone thought they would, they just slammed the brakes and turned off the money drain. Just like that. Quantitative tightening was completely halted. So you've got to ask, why the sudden stop? Why slam on the brakes so hard? Well, they were trying to get ahead of the problem. They saw all these flashing red lights on their dashboard, stress in the money markets, that were basically screaming that the system's cash buffer was running on empty. So they hit the emergency stop to prevent a full-blown financial meltdown. Okay, I know what you're probably thinking. This is all interesting, but what in the world does all this complicated central bank plumbing have to do with the price of Bitcoin? Well, the answer is pretty much everything. It really comes down to this simple analogy. Think of quantitative easing, or QE, the opposite of what we've been talking about, as a giant money faucet. When the Fed cranks that faucet open, cash just floods the system. And where does all that extra money go? A lot of it flows into riskier assets, like tech stocks, and of course crypto, which pushes prices way up. Now, what we just saw them stop is QT, quantitative tightening. That's the money drain. It does the exact opposite, sucks cash out and puts a lid on those same asset prices. And this isn't just a theory, we've got the data to back it up. What's really fascinating is when you look at the numbers, you see this incredibly strong positive correlation. We're talking about a 0.75 correlation between something called the M2 money supply, which is really just a fancy way of saying the total amount of cash in the system, and crypto prices. It's almost a rule. When there's more money sloshing around, crypto goes up. When there's less, crypto goes down. It's that simple. So, knowing this, knowing how tightly linked crypto is to the amount of money in the system, it really helps us answer a huge question. What is Bitcoin, really? In the eyes of the market, is it digital gold, a safe place to hide, or is it something totally different?
And the evidence is pretty clear on this. It tells us two very important things. Number one, yes, Bitcoin is a fantastic hedge against inflation. Why? Because it's scarce. There will only ever be 21 million of them, period. So when governments are turning on the money printers, that scarcity becomes incredibly attractive. But, and this is a big but, number two, it is not a safe haven. It's not like gold. When there's real fear, when markets are panicking, Bitcoin's price tends to fall, and fall hard. It doesn't thrive on fear. It thrives on liquidity.
So that brings us to the really exciting part, the big question. The money drain is off. Interest rates are coming down. What does this mean for Bitcoin and the whole crypto market as we head into 2026?
But what we've got here is what a lot of analysts call a dual policy pivot. You're doing two things at once. You're stopping the money drain, and you're making it cheaper to borrow money. Think about it. For years, crypto had this massive headwind pushing against it. Now, you've not only removed that headwind, you've replaced it with a powerful tailwind. You're setting the perfect stage for a huge recovery. And what could be the result of all this? Well, with this new macro tailwind at its back, some of the high-end forecasts from experts started to get really bold. They weren't just talking about new all-time highs anymore. They were projecting that Bitcoin could actually challenge levels above $200,000. Which kind of leaves us with this one last pretty provocative thought, doesn't it? Here you have an asset class that was literally designed to be separate from the traditional financial system, and yet its fate seems to be hanging on every decision made by a handful of central bankers. It really makes you wonder, what does the future of decentralization even look like when it's so tied to the old world? Anyway, that's all for today. Thanks so much for watching. If this helped you make a little more sense of the big forces moving these markets, do me a favor and hit that like button and subscribe to the CoinCobber channel. We'll see you for the next deep dive.